Hi, let's do a deep dive on some of these macro topics which we briefly went over in the previous video. So, the big one being we see a huge trend in the advanced economies, United States, some of the advanced economies in Europe, like France, Germany, and others, Japan, where we see that the debt to GDP ratio for what the country has accumulated debt over time and as a percentage of current GDP. So one is a stock variable, which is the overall debt, and one is a flow variable, which is a yearly GDP number. If you compare the overall debt to the GDP of these advanced economies, one key trend that we clearly see is that Japan, specifically after the '08 crisis, the global financial crisis, went up significantly, well above 100%. So they were hovering over close to 100%. And then they went up all the way till 140 and continues to go up at 160%. So United States is a laggard per se. Yeah, they were close to less than 80%. But they were, way below actually, close to 45% before. And then they went up as well, but not as much as Japan did. Yeah, meaning they went from 80 to they're already ahead in terms of debt to GDP ratio. They went up too, but they went up from, let's say, close to around 40 to 70, 80%, right? And then they were stable for many years. And then due to the COVID crisis, again, there was a huge jump up for the United States, but still well over, still very high than what it was before, just 10, 15 years ago. We are close to 100% even for the United States. Yeah. France slightly over, but Japan close to 160. These are all advanced economies. So this gives us a preview of what could be coming up next for United States, and is Japan doing okay? And are they able to sustainably do this over more than a decade? Yeah, more than 100% for more than a decade. So the chances are equally likely that United States will also be able to do okay for more than 10 years, um, being more than 100% of debt to GDP ratio. But you never know how many other variables change, so it's hard to know. The one big outlier is Germany, which they started around 40, 43, and they're still around that, um, even after 15 years. So, but this is a global trend for most advanced economies actually start to see higher debt. And one thing that could explain this is there could be, as the governments do their federal budget, um, they could they could have a deficit bias. Primarily by that short horizon that they have for their tenure, they try to maximize um, what they can do, and they would not want to get the voters upset by increasing taxes and or reducing spending. And so because of their short horizon, we would see that the reason why this recourse that most of these advanced economies have is primarily because of this bias that builds into these executives at the government level who might suffer from deficit bias. Yeah. Also, it's hard and understandable that during crisis, '08 crisis, COVID crisis, we start to see that spending wouldn't go down as much from government, but revenues would go down, right? And so those bumps tend to be sticky, meaning they don't just go up during the crisis and come back down, but they just tend to be sticky. Maybe the bumps due to crisis adding to it the deficit bias because they're different governments in action. So debt to GDP, debt as a percent of GDP is one ratio that we can look at, but debt service, which is another ratio, which basically says how much of your GDP is what percentage of your GDP is used to service your debt. Yeah, so debt service ratio. That's another one that I wanted to show. And if we start to see that in the next slide, we will see that then that could be a better ratio. Meaning, what if our economy is actually growing at a much faster pace, and we are able to service the debt, um, even though there's a higher debt, yeah, and debt to GDP is high, but now all of a sudden debt service ratio will actually compare a flow versus a flow, meaning what percentage of your GDP are you actually servicing as debt for that year, and it's now all of a sudden much more of a better metric for us to start looking at. Economists are torn between these two, having higher debt or not having higher debt. So there's no clear um, clear consensus just yet, primarily because of this advancement that can happen in the economy. They could be taking on debt to, primarily if certain advanced economies are investing in the green future, making the planet much more habitable, instead of thinking of this debt being such that the future taxpayers have to pay more debt, then that could be one good use, one could argue, about using higher debt. But there are huge risks to this gamble, primarily if the debt service ratio continues to go higher, then all of a sudden the spending that the government would want to do in certain important areas would be restricted. Yeah. So, primarily, also, if for some reason the revenue slows or there's a huge demographic shift in tax collection, that the demographic is not supporting how much revenue it had originally collected, then that could be another better way to look at what is upcoming in the next few decades. Yeah. So revenue slowing has a huge implication, because then your debt service ratio go up and becomes very hard to service your debt. So the other key factor is if the country like United States can borrow money, and by printing money, which is, you print money and it's free money per se, right? You can borrow money in its own currency and be able to print money, then that further makes it a compelling argument for them to not have to worry about borrowing in some other currency and not being able to print money. Well, print money has a huge issue, as investors who are foreigners of your debt, they would start to look at that and be like, they're just getting away by printing money, right? So there could be some loss of confidence in investments, because the investments are not generating enough revenue, thereby requiring enough of printing. And so if you lose the investment confidence, investment community confidence, then that could be a huge one. um, but the other piece is the US dollar being the global currency. That's another piece that supports, especially the United States situation for higher debt. So, as you can tell, we've now gone into this second area much more in detail. We started looking at deficit bias, started looking at when the debts usually go up as a percentage of GDP. There's an alternate ratio, debt service ratio. So now let's look at that ratio actually. I asked ChatGPT to get the data over the last 10 years and do the math and tell me like what percentage of GDP was used in servicing the debt. And you can see this is a really interesting number. It's very stable, like around 2.4, 2.3%, except in 23 it went up quite a bit, but there was this ratio that's quite stable, which is comforting per se. Yeah, meaning we're growing at a faster rate or equal rate of how this is not increasing. But this gives us a moment to pause. Maybe it's a bump up here, like, and it's going to go back down to the 2.4 average. Then maybe this can go on for many more years, if not many more decades. Hard to predict too much into the future, but stable debt service ratio is another metric. And second aspect to look at is like what kind of people who are paying taxes today or would be paying taxes over the next few decades, how many such people exist. Because if you start to see a huge demographic shift, then all of a sudden the top line, the revenue starts to shift, which could have a huge impact, right? Then this ratio would start to go up as well. So knowing who, which is the dominant generation of taxpayers, the millennials in this case, and as they starts to age, they'll start collecting Social Security and not be paying as much taxes. So replenishing through these newer generation is super, super important for a country over the long run to know that it's able to pay its debt and service the debt, but also generate innovations and improve the profitability of, not profitability, improve the macroeconomic situation of output over time. Yeah. So that's a really good way to also look at this in a different way. And the third aspect to really put this thing in perspective is not just to look at debt to GDP, but look at also like what has happened as I showed in the previous diagram about Japan actually leading the way 160% for more than a decade. And then if you start to lump in China, which if you look at the way the ownership structure is, there are state-owned enterprises, meaning many big companies are actually owned by the state or the government. So there's, if you look at the state-owned debt of those enterprises, the private sector enterprises that are state-owned and the government, then this ratio it can tell us a little bit more about what is actually their debt, right? And so same, we looked at France, we looked at an anomaly with Germany. So looking at it from perspectives of like what has happened with other countries that United States is probably like 20, 30 years behind can also give us a lens of what, how problematic is debt to GDP overall for the country. Um, there are lots of other complex situations that could happen that we would want to look at, but there are these other aspects as I discussed. Debt service ratio could be one, um, a really good one, and also the demographics as to if the country is able to continue to innovate and grow their revenues much faster and have larger tax collection, then all of a sudden this becomes not as big of a problem. Yeah. So this is the second aspect about debt to GDP, which is used in the news quite a bit. And now all of a sudden you can also understand to look at this ratio and try to look at the world overall and also look at the population shifts, which can give you a better indication. So now let's look at China in more detail. Remember, China, if you want to look at China and growth of China, which is phenomenal, there's a really good Twitter video shared by this person that I wanted to show you, and it's comparing China with India. And take a look, like how close they were in 1960s. They were very, very close, and how they have evolved over time. Yeah, so I'm going to play this less than a minute video and take a look. Tell me what you notice. So around 1981, roughly around when I was born, actually India was right after I was born. I think India was doing way better in GDP than China. I did not know that, but look what happened right after that. Interesting, yeah. It's a huge, huge shift that can happen in one person's lifetime. So what China has done is incredible to say the least. And the question, the reason why we see some of these graphs is to ask ourselves, is the model that the Chinese used copyable in other um, wannabe advanced economies or bigger economies? And India per se would fall under um, a pretty large, very good candidate of becoming as big as China did in the next several decades. So then, what did they do? Is there any learnings that we have that we can replicate? So, learning about what actually went into the growth of China will really help us to see, are there lessons that can be learned and applied. Yeah. Specifically, if we compare China and United States from a purchasing power parity standpoint, which equalizes the impact of different currencies. China has different currency than the United States. Also, the price level, inflation numbers are different. So, if you really want to compare them apples to apples in, like, let's say US dollar, then you have to look at it from a purchasing power parity, meaning what is the what is the power of um, someone's ability to buy a basket of goods in these two countries, and if you assume both of them to be equal for the same quality of goods, then you can then compare from ability to purchase. Yeah. And so if you were to compare that, then China, as of the latest data, this data, as I said, different currencies, different price levels, so incredibly hard to compute. So we have data until 2019, and they have it almost surpassed the United States from a purchasing power parity standpoint. Yeah. And so what caused this to go up? And I'll give it an example here. So if a basket of goods costs $100 in the United States and it costs, let's say, 70, if you were to look at US and UK as an example, then we would have purchasing power parity as rate exchange of 1.4. So dollar 1.43 would be equal to euro 1, or in case of China, we would have similar setup that we can use as an example of what would purchase the same basket of goods. Yeah. So if we look at that, then we can compare them and see, oh, China has almost surpassed US, which is a huge factor. So what caused this to happen? And we see that it was the gap was not really starting to close until 2000s. Yeah. So one of the there are three main factors, but like the big one being, if you start to see the investment of China back into their economy is almost double than United States, which is massive. So if you are investing back into the country in better technology, better skilling up your people, um, building better factories, then you would you would have a much higher growth rate, and you would continue to over time get really big. So three key things: lots of really major investments in capital, which like machines, which led to higher productivity of these people. And so output per person, which we will see in the next slide, went up significantly. Yeah. So, and to the extent that the ratios are so big, um, that is also one thing for India to notice. And if we start to see, India is probably looking at this already. The percentage investment is quite high than the United States. um, so that is it's a big one, but quite a bit is used under consumption, which China has like 20 percentage off. So they are able to um, invest significantly more and thus have a net export rather than a net import for both India and United States. Yeah. So we looked at this uh, evolution of India and China in that which is linked here. And as we saw, 5% was what was GDP per person in China compared to a person in US. If a person in US has 100%, a similar Chinese in 1960 would generate 5%. But that went up all the way to 25%, which is huge. Yeah. So they have gone and use of those technology in capital investments have really gotten them the benefit of higher GDP per capita output per person. So technology investments, capital investments, and also more people. They have more people. Um, United States around 300 to 400 million. China is in a billion plus, right? So they have more people to produce goods, larger land, so to be able to produce more. Yeah. But remember, GDP per person is not equal standard of living. Yeah, GDP is not equal. Doesn't include, even if you look at per capita, it doesn't include how um, the happiness is of that person, how they're able to buy a good standard of living in terms of how they're able to maintain their life. It's not you cannot do apples to apples just by looking at GDP per person or GDP per capita and compare that. Yeah, what kind of education is available, how safe they feel. None of that is factored in. Also, if you look at this, GDP per person is an average number. So if you have the 1% top elite, 1% of the top 10% doing really, really well, then they would contribute, and then the average slightly moves up over time. Yeah, so it's an average number for the whole nation. So that's another piece to keep in mind as to how good it is for everyone involved. Yeah. So if we then look at like how is everyone doing better when there's such high growth. So if you look at United States specifically, this is United States number. The bottom half, 50%, are actually getting worse and worse and worse and worse. Top 10% are getting better and better and better and better. Same for top 1%. But this points to not everyone doing well, even though the United States is doing well. And overall, this inequality is growing, but not the case in France. Take a look. The top 10% continues to slowly grind down. They're able to have policies probably that redistribute wealth in a way that benefits the bottom 50%, which has also steadily just been going up and up and up. Similarly, 1% is also steadily going down, down, and down, much lower than what it started off. So it's super important to notice growth, but also notice inequality and how it's persisting in different countries and how our various parts of the pyramid, if you were to say like the top 1%, how they're doing versus the top 10% and the bottom 50%, will be a good one to look at as well. Yeah. And we are also seeing a huge advancement in AI. Would it further make inequality um, harder? Meaning those people who are in automated jobs can will lose more of those jobs, or will it actually be an equalizer where it will enable those folks who are white collar to do even better? So maybe the 1%, the 10% who are able to use these technology tools can get even better. Um, in a sense, what we've seen so far is that the AI advancements that we've seen, not including the robotics just yet, are doing really well when it comes to um, the white collar job or the job that uses the brain in terms of analysis, repeated work, generating content, be it code or answers quickly. So certainly these tools are going to enable those people where actually there is no labor shortage. There are a lot of people who are able to do this work, um, but there is labor shortage quite a bit in the blue collar area, and so advancements in AI that actually connect to the blue collar work is going to also be super helpful. But whether this will displace jobs much more than what it will enable some of these folks to help upskill and also move to that transition, um, I'm quite optimistic, primarily because of many technology revolution, including this computer that I am now broadcasting to all of you, almost at no expense from my side, which would have been impossible to do just 10 years ago. Not 10 years, no, 15, 20 years ago, it would have been very hard. So I am quite bullish that more jobs will be created for those folks who are able to benefit. Otherwise, the 1%, the 10% keep getting better, and then the bottom 50% keep getting worse. So it's super important for policymakers to make the right use of this technology and make the right investments so that the planet is much more inhabitable in the future and we are better off. Primarily, it connects to this last topic, which is we start to see that the average temperature deviation from has started to go up steadily. The world temperatures over time from the mean of if this was, let's say, mean deviations of zero, and it started to go up consistently, almost a degree higher than what we were used to before the 1980s, which has never been recorded before, such increase. So this is no longer um, something that we need to debate on. This is facts, and primarily, will it have an impact when temperature starts to rise on increase in sea levels? And so, huge parts of cities that are on the coastal areas will no longer be able to function as water starts to come in. Temperatures are so high in Africa, India, that it becomes harder and harder to work, and so output and productivity we get harder. Most of the rich countries who were advanced or are advanced right now caused a lot of these emissions over time. So is it maybe their um, duty to help out these emerging economies so that they can have better investments in the greener future and the better planet overall? That is going to be something to see and notice quite seriously over the next few decades, because if you just focus internally on your own country, then the global collaborations will fall off, which could lead to, make no mistake, it's going to have a costly transition to a greener future, but who will bear the cost? Would you expect those economies that are developing and having a much lower per capita income to actually pay the bill? That's going to be a harder pill for them to swallow. And so there's got to be urgent improvement in collaboration and investments in the better future so that the temperature doesn't rise, and this is um, CO2 emission, carbon tax. There's also a net zero initiative that most companies are taking on. So a lot of that is going to be super important as we start to see the world get better or worse. Yeah. So in summary, we have learned through some of these topics, and there are so many more, how the world works, and specifically how the world economy grows, how it gets sick, and what are the policies that politicians and legislators can come up with that can get the economy back on track. So, knowing how the economies grow, how they get sick, get out of whack, and then how they get back on track is the goal of macro. And how do we learn and use the right tools and get the right data and cover many more topics is the key. So where do we get all of this data? I covered Fred briefly, but there are these 6 different sources that I'd like to also cover and show you. Fred, specifically Fred St. Louis Fed.org, is a Federal Reserve economic database, mainly covers the United States, but also other countries, but lots of really frequently updated data. It's available on Fred based on the kinds of data that you're looking at. So if you're looking at US data, go to Fred. If you're looking at all of the other countries, 190, which is like majority of the countries, you look at IMF data, World Economic Outlook, which is released twice a year, is also a really good read. But to get the data for 190 plus countries, which are the member countries of the IMF, you get basic macro data, and you get it at imf.org and look for data sets there. And if you're looking at just the advanced rich countries, specifically other than the United States, but globally, then you would want to look at OECD, Organization for Economic Cooperation, and look at that data set there, which is, they net represents 70% of the world output. So that's a good source as well. If you're looking specifically in the even more detail in Europe, in the EU member countries, you look at europa.eu, so economic finance, EC, europa.eu. It's a good one. If you're looking for lots of really good, interesting figures and visuals, then you look at our world in data.org. And the Economist magazine, that's the only one that's not free from all of this. And there are lots of really good blog posts to stay up to date with what's happening in the world economy. So these are some data sources. I also wanted to show you some of them. So this is Fred. You put in, they're already giving you some of the items that you can look at. IMF for the 170 plus countries, that 190 plus countries as of 2024, that you get basic data. OECD for all the rich countries, and for EU specifically, you go here, yeah. And for really good insights, you go here with Our World in Data. In the blog posts, there are about so many really good blog posts, so you can go to On Analytica, um, and then get links to some of these blog posts that are quite popular. Yeah, so really good set of links. I wanted to also end with giving you a quick preview of what's coming up in the next video. We are going to go to chapter 2. So we finished chapter 1 quite a bit. Chapter 2 is the tour of the book. So this gives us, we did the world tour. Now we're going to do a tour of the book. And what are the key aspects that we'll cover in chapter 2? The 4 big ones are, we're going to go in detail about output, GDP, as to what does it, what are the key areas that make up the GDP. If you've looked at the national income accounting video, then you probably have some idea, but if not, don't worry, we'll actually go in quite a bit of detail in output. We'll look at unemployment rate, because if more people are unemployed or not able to find the job, then they are unproductive, not being able to make the money, less taxes, and so on. So this is important. Inflation, if things are just expensive, what causes inflation to go up? And then finally, what are the relationships between these three: output, unemployment, inflation? We look at the Okun's law and Phillips curve. So that's what's coming up in chapter 2. But at a high level, what we're also going to look at after that in chapter 3 to 6 is a short run. So anything less than a year, these are the core principles that you'd want to apply when you're trying to predict what could happen in about a year time frame. So we'll learn about some of the frameworks and principles in the short run, how the macro operates, and what are the tools and policies that are available to you in the short run in chapter 3 to 6. Then we will look at, in the medium run, chapter 7 to 9, anything less than a decade, less than 10 years. But you have 10 years, then you can use some of the tools and policies, principles, and frameworks from the medium run. And finally, the long run, anything more than a decade and half a century. And that's what's applicable for everything that we learn in the long run. And once we do that, then we can actually start to look at various other parts on extensions, expectations, and how the open economy, in this case, United States open economy and closed economy. So we'll look at some of those extensions as well. So that gives you a quick overview of what's coming up next. So that is chapter 1, part 2 in the recap. Thanks, everyone.